Hi, Digital Disruption Series, Episode 4. Continuing with the BFSI theme, I am pleased to bring to you today the concept of peer to peer or social insurance. In peer to peer insurance, people with similar insurable risks or similar interests pool their resources together to hedge their risks. At the end of the cover period, the unused premiums are paid back to the to the insurees, thereby making it more cost effective than traditional insurance. The question that we are going to discuss today is peer to peer insurance scalable? One, and B is, can they be a serious alternative to traditional careers? And with that, let us go into the main presentation. And here goes peer to peer insurance, episode 4. Before we get into the discussion around different models of peer to peer insurance, I'd like to bring about the differences between traditional and P2P insurance. In the traditional business model, pooling of risks of large number of individuals with different profiles happens under a similar cover. So underwriting is done based on individual risks and therefore the premium is charged accordingly. On the other hand, in a peer to peer insurance model, pooling of risk of a smaller pool of friends, family, and acquaintances, a known pool with similar profile and insurable risks, create the peer to peer insurance model. Now, the big difference between the traditional and P2P insurance models is profit retention or surplus distribution. The insurance company or a traditional insurance carrier is motivated by profit. So it retains the amount of excess in the pool at the end of the coverage as its profit after paying all costs and premium, all costs and reinsurance. So it's built for profit. On the other hand, residual funds in excess of claims deposits refunded to the members of the pool. Therefore, peer-to-peer insurance conceptually is designed to eliminate the conflict between insurers and insured in terms of the unused premium. Now, the deeper question is, who should own the unused premium? Should it be distributed, or should the insurance companies, because of the administrative costs and other expenses, retain it back and plow it back into the business? So that's one dimension of debate, if you may, that fundamentally has given rise to the concept of peer-to-peer insurance. So when I looked at peer-to-peer or P2P insurance models, I scanned and curated content from all across, and I could actually put it into four broad buckets in terms of four broad business model archetypes. So while peer-to-peer insurance, again at another level, it has two fundamental models, which is the brokerage or intermediary model and a carrier model. A carrier model is one which has an insurance license, and the best example that I can think of a peer-to-peer insurance company which is operates on a carrier model is Lemonade. And we are not covering Lemonade in this discussion because Lemonade was covered extensively as a insurer, AI based insurer, in our property and casualty insurance video, and you can look it up for references to Lemonade. So going back, there are four models: community, broad coverage models, niche models, and deep tech models. Now, I'll start with the community models, and community models are not monoliths. There are large community models, which are very deep social models, and the example of that model is Laka, the bicycle insurance company. It is a unique community-based product, which is a bicycle insured model, and its basic product is bike and gear insurance against theft and damage. Second is health and recovery insurance, and the third is Laka Club. Now, which is basically third-party insurance. In Laka's unique community model, the total cost of insuring all kits are divided between each member every month. The amount payable by the member fluctuates across months, but according to estimate, it saves approximately 40% compared to other bicycle insurance companies, typically PedalSure, Eversure, BikeMo, and so on and so forth. Now, the point here is users need to pay a 12-month subscription premium up to a pre-decided cap. Any claims over and above the consolidated cap amount is paid by Munich, which is hired by Laka as a stop loss insurer. So you have a cap, and anything above the cap is paid by a reinsurer, which is pretty cool. The other important thing is Laka's third-party insurance model, which is the Laka Club, creates a community feeling, and it's a large community of bikers who actually share content and so on and so forth. It's almost like social commerce backed by insurance. The second one is SoSure, which is mobile and content insurance. Now, you actually buy a policy in SoSure and kind of invite your friend to SoSure. Your friend buys a policy, and then both of you connect each other, and both of you receive dollars 10 in your reward points kitty. If four friends connect, you get $40 as reward pots, and if eight friends connect, it is $80. If none of the connections make a claim, up to 80% of the premium is paid back, which means 20% is withheld by the company for its administration, technology, and other costs. So it's a very interesting close community model. Now, if I move on to the third model, which is a pet insurance model, which is a community within a community. So it's ISHO. It's basically community based pet insurance, where all members are enrolled in the same standardized plans. Membership covering all aspects related to illness, accidents, preventive care, etc. are covered in these plans. Once a pet is signed up, the owner applies to join a cost saving community, which are basically groups which can be contain 10 to 400 members, which makes it a community within a community. So you would have small specialized communities and larger communities. You can see that the communities average claims for the last 6 months before joining, so you actually know what is your costs and which community sub community to join, and so on and so forth. At the end of each month, the entire community expenses are added up and divided amongst community members. Now, the reason why so if you look at bike insurance or mobile insurance or pet insurance, there are multiple players around it, and those multiple players are basically digital first insurance companies, but are not peer to peer. So when I looked at the advantages of these kind of peer to peer digital first community based insurance players, their broad advantage are they cover more types of they have more features, cover more types. As in pet insurance, they cover more treatments than standard pet insurance players. They're more transparent. They're However, one could argue that the variable costs are kind of a tricky part of this whole equation. While a traditional insurer, the costs would be fixed. But the other way to look at it is that variable costs, while there might be variable, but beyond a point cap, it is reinsured. And only one disadvantage in the peer-to-peer pet insurance is that no coverage for pre-existing conditions, which the other companies would kind of allow you to do so. However, these companies are gaining traction in their respective spaces, and as social commerce is becoming more and more mainstream, we see an uptake in community-based insurances. Moving on, the next one is broad coverage, and this is Friend Insurance. Friend Insurance is a German-based peer-to-peer insurance model. It is a pure broker model which has 175 partner organizations across multiple product lines, but primarily focused on electronics, goods, disability insurance, legal protection. Consumers select a product that they are interested in and are connected to a small group of other customers who have similar insurance needs. These customers' premiums are pooled together. One portion of it is paid to the insurance company, and other is kept in the cashback fund. As claims are made during the year, the cashback fund decreases. At the end of the year, any remaining cash is distributed to each customer. On an average, 80% of the customers receive 30% of their premiums back. And today, Friend Insurance has scaled up and serves more than 100,000 customers across its various product categories and communities. Now, the next one is what is called a niche insurance company, and a niche insurance peer-to-peer model is in the form of Bought by Many. Now, Bought by Many is a very interesting company. It brings communities with similar interests together and negotiates for a community as a collective to secure better insurance deals than individuals, both in terms of pricing and coverage. So you have pet insurance, you would have disability insurance, and other different kinds of insurance aggregated together by this platform called Bought by Many. The third one is unique. It is Nexus Mutual, and it is about using technology to make insurance much more transparent, peer-to-peer insurance much more transparent. It is basically for Ethereum users, which is a decentralized open source blockchain with smart contracts. And just so that we are clear, smart contracts are contracts which deal with microdata of huge volumes that are charged under different conditions and cannot be processed by traditional accounting systems, and therefore they use blockchain based technologies to keep records and do the transactions correctly. Now, Nexus Mutual protects against hacks of smart contract codes, which and members hold token which represent membership rights. Members can contribute to the pool by purchasing smart contracts when when a claim is raised. It is about the members come together and vote for the payout of the claim. Claims are, however, need to be settled between 12 to 48 months, 48 hours. Now, again, this is a very interesting. While all of these models apparently are very interesting, and this pooling of interest concept obviously creates transparency. It creates it creates people of similar interest to come together and a community feeling. The question is it scalable? How many times can we figure out large communities and hold the communities together? Is insurance a good enough bonding model? And therefore, the important question that obviously would be raised is this a scalable model? Is it going to disrupt insurance per se? And that's what I'm going to cover in the next slide. Yeah, just hold on. Okay, as the slide comes up, question: will P2P insurance disrupt traditional model? It's a big market for sure. It is about stated to be 63.2 billion by 2025 and growing at a very rapid rate at 32%. Now, while the market is big, you've got to put it in context. It is right now approximately 1% of the insurance market. And with a gallop rate of 32%, it doesn't seem to make a big difference to the traditional insurance players. Though I fully believe that the idea is innovative, but not big enough. The second is scale makes the product undifferentiated, which means the sustenance of the P2P model beyond cost and transparency would it be its ability to maintain the social connect and small knitted groups. Now, by that definition, it is not naturally scalable. And as groups grow larger, the risk profile will become diverse. With the diversity and the complications of the risk profile, it will look like a traditional insurer, and where it would find it very difficult to create a value proposition or a differentiation from a traditional carrier. The third point is technology adoption, and as we saw in the blockchain adoption of this model through Nexus Mutual, more and more technologies will help the P2P models grow, and the claim and transparency processes would become much more driven by technology, and therefore far more transparent than it is currently. Having said so, just to kind of conclude, I am a great believer in social commerce as a big theme, and P2B insurance as a subset of social commerce. However, with the data and statistics, though it is going to grow, it's not going to be a significant challenge to the insurance industry. Having said so, there will be certain communities and insurable interests which will create unique product models, and eventually probably the traditional insurance players will ape those product models, if not in the format of social commerce. So to conclude, social commerce is still going to be a niche, small part of the entire insurance landscape, serving unique needs, pooling interests, and being cost effective and transparent, but I do not see them as a major threat to traditional insurance carriers. So I hope you liked the video, and if you did, share this content to your friends, colleagues, and anybody interested in technology and digital. And as we move on, we are going to bring you more and more videos, so stay tuned and watch the space. Thank you very much for your time.